In this week's update, what key signals I'm watching, how to make the best out of what is a challenging market, and Bitcoin gets punctured. My name's Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. Okay, we'll start with some market perspective today as usual, and I think there's a bit of clarity coming to the situation just in the last week with regards to inflation in particular, because up until now there's been fear about inflation but not necessarily the hard evidence, and people have been looking for inflation since 2012 when all the incredible stimulus started, and it didn't ever materialise. But there is certainly some evidence now that we are seeing inflation start to pick up. And the US CPI was up 2.6% from March to April, just in the last month. So that's a big jump in 1 month. And it was also up 4.2% compared to the same period last year. Now, that, of course, is comparing it to a period when COVID had just struck, and naturally it's coming off a low base. So that 4.2% is a bit misleading on face value. But there seems little doubt that we are getting some inflation. The question is, and no one really knows the answer to this, is it a transient situation as the Fed is saying? But then again, the Fed has to say that. You know, if the Fed were to say that inflation is going to continue to rise, then the market would absolutely freak out. So the Fed has to say that. But are they right? Or are they just trying to talk the market down? I guess we'll know in 3 months, 6 months' time. It'll become clearer, and so we've just got to allow for the possibility that inflation is probably not going to break out in a significant way, but we are probably in a period where we are going to see a bit of a spike, and it's how markets react to that. The other thing that's becoming a little clearer too is that both local Australian and also US tech stocks, the darling stocks, the A2 Milks and the Appens and the Altiums in America, there's just hundreds and hundreds of darling tech stocks, are a bit on the nose at the moment. The market really doesn't want to know about it. We're getting a significant contraction in multiples where the market would have been prepared to pay 30, 40, 50 times sales, which really defies any sort of logical analysis. But now it's just not. It's now only prepared to pay half that much or less. And it's not that anything has changed with the business. The businesses are still doing exactly what they've always been doing. It's just that the multiple the market is prepared to pay has contracted from a crazy level to a less crazy level, and could actually have further to fall yet. I'm not saying that we've reached a bottom in that metric either. So the question is, at some point, will that reverse? Look, absolutely, I can say with conviction that there will be a point in time in the future where the growth and progression of technology businesses gets the market focused back on just how strong the growth is. And so that will reverse for certain sectors of the technology market, and that'll create great opportunities. So I'm still extremely positive about the opportunities that technology will offer. And inevitably in these sort of sentiment corrections, we get an overshoot in both directions. In 2020, we saw an amazing overshoot to the upside that culminated in an incredible surge in November, December, January, when we had all the Reddit trading going on as well. And it's highly likely that we're going to overshoot to the downside as well. So I sort of feel that tech stocks have probably still got some more downside in them yet, but that will set up some terrific opportunities. So what are the key indicators? Beg your pardon. What are the key indicators that I'm watching? Well, certainly spikes and reversals in the VIX index are a really reliable point to base some of your timing off. So that's one of them. The second one is the growth versus value ratio that I've been highlighting for a long time, and also the staples versus discretionary is another one. So there's some of the key indicators that I'm watching. But in addition, when you're going through hundreds and hundreds of stocks every day, as I do, it's easy to see a bit of a trend emerging in how individual stocks in different sectors are responding to news. In the more aggressive sectors, positive news is met with not much price reaction, and anything that's not quite right is generally bringing a bit of a price smashing at the moment. Whereas in other sectors, it's quite a different reaction. So that is quite an interesting dynamic at the moment. If we look at this chart here, so this shows the US CPI over the last 20 years. And obviously the key thing is right over there on the right-hand side. We can see that that the 12-month percentage change on the CPI is starting to kick up to levels that we haven't seen for quite some time. And the shaded areas, there are two shaded areas there, they represent recessionary periods in the market. So obviously around 2000 and 2008. I'll come back to why semiconductors are weak, because that's a bit of a strange one at the moment. But let's just look at the VIX index. So this is the VIX over the last 12 months, and you can see the spike that we've just had in the last few days. It's nothing as high as the spikes that we saw on several occasions in the last 12 months, but it certainly came out of nowhere because the VIX had dropped below 20 for the first time in quite a while. We got a sudden spike, and then even more miraculously, it just all disappeared again. I mean, it defies logic that on Monday everybody's calm and happy. On Tuesday, everybody is totally anxious and reaching for the put options, which is what kicks the VIX up. And then by Friday, it's all gone back to where it was. It's really difficult to understand how human nature can change on a dime like that. So you've really got to assume that it's really more about what the computer algorithms are doing. So that's it on a 6-month chart, and just zeroing in over the last month, you can see quite a sharp spike in the last month. The only point that I would make about this is that we often don't get significant bottoms until the VIX spikes above 30 or even more. When the VIX spikes above 30 or 40, which is even rarer, then we tend to generally only last for a couple of days, and that generally marks a significant bottom in the market. We didn't quite get there this time, and that's why I think with the seasonality and everything else I've been talking about in recent weeks, why I still think that I'm leaving the door open for just another spike in the VIX, which would carve out a much more tradable low in the market. Anyway, we'll see how that one plays out. Now, just turning back to semiconductors. Semiconductors is fundamentally a very, very strong area of the market, and they're surprisingly weak at the moment. So why is that? Where demand for semiconductors is absolutely massive. It's going to continue for years and years to come before they can catch up, and yet stock prices are falling. Well, I think there's a couple of things. There's certainly the issue of global supply chains, and this is really more one of fear about what would happen rather than actually what is happening at the moment. Now, the reality in the semiconductor market is that Taiwan produces around 80% of the global supply, and there is a little bit of COVID coming back in Taiwan. They've got a very good record of managing COVID, and the fear, of course, is that they go into an isolation of workers, which would prevent the semiconductor foundries from operating, and that could just make what is currently a global shortage make it even worse. So they've got a really good record. So I think this is only going to be a transient issue, even if it is developing at all. I think this is just more about fear at a time when people are looking to sell tech stocks. So those two things together. But they're both transient, and therefore I think semiconductors, whilst they're a little bit weak at the moment, I think are setting up for a terrific opportunity. All right, let's turn now to American stocks. The S&P was down 1.4% for the week. And when I just look at the weight of evidence, you can find reasons why the market could go up, but I can just find more reasons why the market could go down in the short term. So I think the weight of evidence does support the downside. And when I look at things from a risk-reward point of view, it's hard to see much upside. The market may not go down, but I'm really struggling to see what would get the market going up. So to me, it's not worth the risk in the next month of aggressively attacking this market. The US dollar finished flat. I think it was up very, very slightly, but essentially flat to 90.32. The yield did jump up a bit with the inflation data, and as we saw, the VIX spiked to 27, but then ended up back down under 19. All right, we'll just start quickly, have a quick peek at the Bitcoin chart. And I spoke last week about the fact that we'd broken a swing low, we'd formed a low, we'd rebounded into the range, formed a lower high, and that there was a very good chance that we would get a C leg to the downside into this green shaded area here. Well, Elon Musk made some comments through the week that certainly punctured the Bitcoin price. We've now come down and we've now got a double bottom. That, in some circumstances, constitutes the C leg. The C leg doesn't have to go to a lower low, so this might be it. But I still think, again, the weight of evidence would support Bitcoin coming back further yet. So that's my technical view of Bitcoin. The S&P, this is I've just put some VIX numbers here just to show you the correlation that occurs. So you can see that sometimes the VIX is an early indicator. So the VIX spikes up before the market falls. That happened here. But most of the time, a spike in the VIX generally corresponds to a low in the market. And you can see here we spiked to 29. That was a low. We spiked to 41 here. That was a low. Up to 38. That was a fairly short-term low. 28 here, and we've just hit 28 again. So is this the low, or is there another bit to come? I don't know. Time will tell. But as I said, the weight of evidence, I just think, given the seasonality, I just wouldn't be surprised to see another leg to the downside. And if we look at the Nasdaq, you can see it's definitely underperforming the S&P. The moving averages have now flattened out. The shorter term ones, the 50 and the 20, have now flattened out, and the price is starting to spend a little bit more time below the 50-day moving average. So definitely that sector of the market is weaker. Now, if we look at the US dollar, we are still in the mode of forming lower highs and lower lows within this fairly short time frame. We're still in an overall sideways move that has been on all year, and we'll get some support coming in just below 90. And the Australian dollar, not quite mirroring what's happening in the US. I guess part of the reason that the Australian dollar's been a little bit weaker than the US is that there's certainly a lot of chatter around what the iron ore price might do. So turning now to Australian stocks, 77.4 was where we finished. Our index gave up 1%, and materials were the lagging sector last week, surprisingly, given how well commodity prices are going. And real earnings are becoming important again, with particularly with small caps. The market is certainly looking at looking at the fact that the speculation is not probably as strong a theme as it was last year. But we're still seeing a good element of healthy speculation in resources. So there's still opportunities emerging there. Now, one thing that I didn't show is just some of these spreads. So this is consumer discretionary versus consumer staples, and you can see in the last week certainly consumer staples did better than consumer discretionary, and we haven't seen that for some time. So whether this support level here breaks and we get, that would be a bad sign for the market, because the situation we've got here with growth versus value, it's dropped to another level and is close to support, but that's more about a rotation that's going from the aggressive sectors of the market to the more conservative sectors of the market. But I would probably be even more concerned if this one breaks down, because if money starts coming out of consumer discretionary and going into consumer staples, then I think that's a more meaningful change. So we're at a pretty key point here over the next couple of weeks, and if that level there were to break, then I think that would certainly add more weight to my argument that we've got some more downside in the general market. Okay, turning now to precious metals. Gold going $12 to 18.43. Silver was essentially flat, around 27.5. And gold is really carving out a pretty consistent uptrend, as we'll see. And GDX also, clearly the uptrend channel there is continuing to unfold. So let's take a look at precious metals. I'll just check in on the Australian market first of all. So there's the Australian index. We had heavy selling on Tuesday, Wednesday and Thursday, and the majority of it was in material stocks. But there's the gold price. You can see continuing to set new short to medium term highs. That's on a daily chart, and we're just about to challenge the 200-day moving average. So if it can get above this 200-day moving average, that will bring in some technical selling, some technical buying, I should say. So we're looking at a zone here between getting above the 200-day and then getting above these highs here. So if it can clear this zone, then you're going to see a rush of buying, I believe, that can push gold up into the 1900s. So the outlook is pretty good for gold, and that's gold on a weekly chart. So you can see, there's no question now we've come back into the range and it's looking pretty strong. Silver is still really just tracking sideways. We had a real burst of buying in silver back in August of last year, and then it's largely gone sideways since there. And if we look at GDX, so there's clearly an uptrend there. Higher highs, higher lows. The channel looks really good. So GDX looking very positive. And remember, I set this probably 4 or 5 weeks ago that the average, now there's a bit of a spread around these results, but the average for GDX, an up leg, it lasts on average around 7 months, and it goes up by something like 95%. Sometimes less, sometimes more, but that's typically what you would expect. So it's a significant move. Other commodities, copper and nickel, these slightly, that was really more just currency related. It's still a very bullish price for both, $464 and $790 for nickel. The copper market threatens to fall into an even larger supply deficit. We've got issues in South America, in Chile and Peru, which are the biggest producers of copper, and there's several issues there that could further limit the investment in copper and could further limit the supply of copper onto the global market. So that sector was already heading for a global supply deficit. There's every reason to suspect that deficit could get bigger, and that's going to push the prices up. In Australia, there are several really exciting local developers in base metals, and that's why we're still seeing some very buoyant share prices. So certainly opportunities in Australia in that area of the market. Crude oil was higher to 65.37, certainly helped a bit by the currency, and XLE is still doing pretty well. It's one of the outperformers in the US market. There's the spot copper chart showing a bit of an easing last week. Same thing with nickel. And just to wrap everything up, this is not a market to be avoided. So, I still think we can participate in this market, but it's just about adjusting the balance to suit the circumstances we've got now. If you wanted to do well in 2020, then you wanted to be in technology, consumer discretionary, those sorts of aggressive areas of the market. That's not where you want your balance at the moment. And the other part is that this is still an evolving market. So you need to be prepared to shift your balance around as circumstances unfold. So for me, it's about not forming strong opinions on what should happen. Just watch the charts, follow what is, and that will be probably the best stance that traders can follow. Portfolio analyst last week was a big one. I went through the full fundamental analysis process that I use, showed the tools that I use. I also went through the case for copper and uranium stocks, which are very compelling. There was a segment there on risk management, and we went through every one of the portfolio stocks in review as well. So I think a really productive week. If you haven't taken the trial on Portfolio Analyst, then $1 for 2 weeks. I think it's still a very good thing to do. So that's it for this week. There's the website and email address for anyone that wants more information. And I'll be back with you next Sunday. Cheers.